How's it going, friends and family? My name is Amos, and in this video, I'm going to be teaching you how to use a stock screener on a micro level and on a macro level in order to filter out the noise and to find high quality dividend compounders with cheese or just good stocks in general. And I'm also going to be teaching you a third way to find 10 baggers, as Peter Lynch likes to say. Companies and stocks and businesses that are small right now, but have the potential to compound into something magnificent and into something that is beautiful in the future, maybe like 5 or 10 years down the road. And keep in mind, I am not a financial advisor, okay? I'm just a guy that showers naked, that just likes making videos and sharing my passion with the world. So it's going to be a little different than the usual content. It's going to be a tutorial. So what you see on your screen right now, the first thing that I like to do is to go on tradingview.com. This is a free website and a platform, and I like to look at the S&P 500 heat map. So what you are seeing is a visual depiction, and that's the scale down below. If it's green, that means year to date, this company is positive in their share price appreciation. If it's red, that means for the past 9 months, they're in the negative. It's pretty self-explanatory. And the reason why I like to start off with the heat map is that it allows my eye to look at the stock market. The S&P 500 is otherwise referred to as the market, the benchmark, the standard. It has all of the major industries and sectors represented. As you can see on the top left, it has the tech companies, and as you can see in the middle, finance, retail, health, consumer non-durables. Those are basically stuff that we buy that only lasts for that moment, like a drink, a beverage, food, or even tobacco products. And then there's also consumer services. This includes stuff like the streaming sites, restaurants, transportation. And so on a high level, I think we can go ahead and make the assumption that tech, dude, they're crushing it. NVIDIA, they're up by 30%. Google, 26%. Broadcom is 52%. I think the only Mag 7 that's kind of an eyesore is Apple, down by 6%. I think finance, pretty good. Modest numbers. I think JP Morgan Chase is leading the way with 27%. I think health is where a bulk or a majority of the companies represented are in the red rather than green. So if we make it bigger, we can kind of take a look at what's going on. Johnson & Johnson is leading the way, 22.6%. Okay, I lied. Gilead is 23.6%, but almost every other pharmaceutical is kind of suffering right now. Bristol Myers Squibb, Pfizer, Danaher, Eli Lilly, suffering. And another sector that's not doing too well, consumer non-durables. You got Procter & Gamble down by 6%. You have Keurig Dr. Pepper, 15.7% in the red year to date. Past 9 months. We also have General Mills in the red by almost 22%. Lululemon, they might get kicked out of the S&P 500 during the next index fund rebalance because they are suffering huge right now. You also have Clorox, Campbell's, Smucker's, Hormel. It seems like the grocery aisle businesses, they're not thriving too well. Whereas on the other hand, Monster, that manufactures energy drinks, they're crushing it. Same with the tobacco stocks. Philip Morris and Altria, thriving. The grocery aisle, not doing too hot. I guess that also includes the clothing retail apparel like Nike, Lululemon. I think they're hurting right now. And I think other than that, it seems like on a high level, most of the stock market, they're thriving. So with that out of the way, now I'm on a website called stockanalysis.com. I'm not exactly sure if this stock screener portion is paid or not, but I will show you a free version to do this when we talk about the micro level of using the stock screener. So right now we're still looking at things on a macro level, on a big scale. So if you take a look at the 11 sectors represented in the stock market, it seems like as of right now, in a 1-year change, every sector is thriving. Leading the way, we have the comm services. If we click it to see which companies are represented, it's the Mag 7. Google, Facebook, Netflix, T-Mobile, AT&T, the list goes on. And the one that's barely break even are the REITs. Real estate is 0.31% for the past 1 year. And I think 3 of them are pretty much tied for 9%. You have energy, this includes like oil and gas. You have consumer staples and healthcare at 9%. But other than the comm services, I think consumer discretionary at 35% is pretty surprising to me. However, if we look at it on a short-term level, the ones that are kind of for the past 30 days, consumer staples, their 1 month performance as a whole, as an aggregate of the 251 businesses that are represented by consumer staples, talking about negative 1.3%. And for the utilities, it's pretty much flat. Now, in the past 1 month, the one that had the biggest upside has been comm services. So I don't want to invest into a sector or into a stock that is overweight, that has a high trading multiple, because the rotation out of that sector is going to be more likely in the future. Does that make sense? I would like to invest into the beaten up industries or sectors where people are like, ew, you're smelly, you're disgusting, because I know in a matter of time, the money will be flowing back into that space. So if we just jump on over and take a look at the consumer staples, take a look at what is going on. Looks like Walmart is leading the way at a 31%. And now we get to see within the consumer staples sector, who are the businesses and entities that are struggling. So right off the bat, we have Procter & Gamble, past 1 year, negative 9.2%. And these are the filters that I like to apply in the indicators. There's over 279. I like to look at the 1 year change in their stock price, but I also like to look at their forward trading multiple. Meaning when you take their stock price and you divide it by the earnings per share, the earnings per share is basically the profits per share or the bottom line per share. It shows you how profitable a company is, but also how efficient they are in running their operations. So at 37.6 for Walmart, I would argue that's pretty high, because when you take a look at the third filter that I like to use, it's the 10-year average for their PE ratio. They usually trade for about a 29.3. So I know right off the bat that as of right now on a surface level that Walmart is overvalued according to their own metrics and timeline when you compare them to themselves. However, when we take a look at Procter & Gamble, their 1 year price change is negative 9.2%. And their PE ratio is a 22.5. And it might sound in line and normal until you take into account how their past 10-year PE ratio is a 28. So if we click and investigate the Procter & Gamble company, this is a business operation that pretty much manufactures almost everything and anything in a grocery aisle, including laundry, detergent, and shampoo. Pretty high quality dividend compounder with cheese. Take a look at their financials. Everything checks out. Their revenue is growing year over year. Every single year since 2017, I would argue they've been consistently going up and to the right. Obviously, this is not an AI, NVIDIA, or Microsoft type of company. Take a look at their profitability. This is the earnings per share. Little volatility up until the pandemic, and then they've been consistent. They're going up and to the right. As of right now, they're generating $6.51 of profits per share. Why do I keep mentioning the per share? Because as a shareholder of a business, you don't want them to be diluting the shareholders by issuing more shares every single quarter or every single year. Because what happens is the earnings per share, the profits per share is going to take a hit. Meaning, when we take a look at Procter & Gamble's shares outstanding since 2016, it was 2.8 billion, right? It's going in the right direction. For every other financial metric and fundamental, we want to see it be growing. However, I would argue for the shares outstanding, it needs to be the exact opposite trend. You want to see it be shrinking, because consequently what happens is then your earnings per share goes up if the shares outstanding goes down. And it also plays into your free cash flow per share. And as you can see, year after year, they keep buying back their shares, and now there's 2.4 billion shares outstanding. So right off the bat, I know that this company is growing objectively because their gross sales, which is depicted by their revenue, is growing year after year since 2017. And I know they're a very efficient operation because since 2019, their net income per share looks pretty rock solid. Okay, and there's some other things that we can take a look at. For instance, we could take a look at their free cash flow. This is on the cash flow statement. And as of right now, the free cash flow per share is $5.72. And if we jump on over to the dividend profile, keep that number in mind. They pay out $4.23 in dividends per year. Now, how is the dividend payout ratio defined and calculated? And you derive the dividend payout ratio by taking the earnings per share, also known as the profits per share, and dividing it by the dividends per share that's paid out. In this case, it's $4.23. But something else that I like to do is to consider the free cash flow payout ratio. So when you take into account the cash that's generated from their operations, how much of that cash will be utilized for the dividends? So I think it was $5.72. We're going to take $4.23 in dividends paid out per year, and we're going to divide it by $5.72 to figure out the free cash flow payout ratio, times that by 100. So it's a 73.9%. For a company that's as established and as mature as Procter & Gamble, I would argue that's pretty healthy and in line with what you want to see. And is their dividend growing? Not only is it growing at a rate of 6% year over year, but they've been growing it for the past 69 years. Now, Procter & Gamble, if you want further commentary, you should go ahead and watch the Dividend Kings ranking video that I just uploaded. There is a part 1 and a part 2, but I go over and I analyze the Dividend Kings. Amos, what is a dividend king? It's a stock that is publicly traded in the US that has been growing their dividend for at least 50 years. So if you're curious to know more about Procter & Gamble and some of the other dividend kings, please hop on over to that company. So right off the bat, taking a look at the sector breakdown and the consumer staples, Procter & Gamble would be on my radar because from their financials, what I can gather is that it looks to be pretty high quality and they seem to be on the lower end of the average PE in their own sector. It's a 28.7. Procter & Gamble is a 22.6. Undervalued, high quality, pretty stable and good dividend profile. It hits all of the check boxes on my list of what I like to look for. And then we also have Coca-Cola. We could do the exact same thing that we just did with the Procter & Gamble. However, let's jump on back and I want to show you this. If we click on overview, it'll show you every sector, but also every industry that's within that sector. Does that make sense? So a sector is like the overview of a category, and then the industries is everything that comprises that sector. So if we take a look at healthcare, there's over 1,113 stocks represented by healthcare, and when you break that down in an industry level, 624, oh my goodness, that's a lot, are in the category of biotechnology. So the industry of biotech makes up about half of the healthcare field. And overall in the stock market, there's 11 sectors and over 145 different industries. It's a lot, right? And that's why this screener kind of helps you. It's like you're doing a manual SQL analysis to figure out what's worth looking into. Because if you just blindly look at stocks, you don't know if it's undervalued or not. Correct? And that's why with a screener, it kind of helps you to look at stuff on an objective and datas and numbers kind of way. And in the space of healthcare, overall, they're pretty much in the green, right? But that's not the full truth and the full story. Because when you look at it broken down, I would argue as of right now, the healthcare plans, dude, negative 24.5% for the past 1 year. And if we click over here and take a look at what's going on, my goodness gracious. I'm not exactly a fan of the default indicators. So what we're going to do is get rid of them. We're going to get rid of the market cap, price change, volume, revenue, and instead we're going to apply the ones that I think are more relevant. So we're going to look at the change in 1 year for their price. So 365 days. And then we're also going to look at their forward trading multiple because it tells you the valuation of a company, like is it trading for a pretty premium or are they undervalued? And I say quote unquote because sometimes a company has a really low PE ratio, not because they're undervalued, but because they're a piece of crap and they're ugly. So they're being priced accordingly by the market. And if we do forward trading multiple, and then I, of course, the 10-year average to figure out if their PE is actually cheap or if it's expensive. And click that right there. And after we apply the filters that I prefer on the indicators, then United Health, their past 1 year, just the share price appreciation alone, down negative 40.2%, and their forward trading multiple is a 22. That's another way of saying the PE ratio. And their 10-year average is 22. So they're finally back to where they should be in terms of their valuation. Cigna is negative 15.3%. Elevance is negative 42%. Centene, negative 54%. I know it sounds counterintuitive or even ridiculous for me not to be wanting to look at the ones that are up by 33% or 49%, but it's because I hold this contrarian strategy where I like to invest into high quality compounders that are beaten up. Because more often than not, according to the data from the research that I looked at, please watch that video, they usually have a higher probability and a chance of making a rebound and coming back. So when you buy into a high quality stock that's at their absolute lows for the past 1, 5, or 10 years, the upside and the gains potential, it's in my favor. Now, obviously, past performance is not indicative of future gains. So just because a stock is down by 54.7% does not mean that they're going to recover. They could, in fact, go belly up and go bankrupt. So I like to look at the ones that are beaten up, and then I would do the exact same thing that I did with the Procter & Gamble company to see if their financials make sense. I guess just for illustration purposes, let's go ahead and take a look at Centene. They primarily do government-backed health insurance plans like Medicaid and Medicare. When we take a look at their top line, you tell me, does this look like a disgusting company that should be negative 54%? My goodness. Total revenue past 1 year is $159 billion. Take a look at their earnings per share. $4.07 seems to be a little volatile, but not too bad in relation to their revenue growth. And if we jump on over to their cash flow statement to figure out their free cash flow situation, free cash flow per share is $2.14, which is a huge improvement from last year where they were negative 94 cents per share outstanding. So Centene, right off the bat, would be on my radar, and I would want to do further research to see, is this company ugly, hideous, or are they a hidden gem? So that's the macro way to evaluate and look for stocks using a stock screener. And now I want to show you how to use a stock screener to evaluate the entire stock market with the filters applied. That way it's not so overwhelming, because if we don't apply the filters, there's thousands of different publicly traded stocks in various countries to sift through to find something that's cute and pretty and beautiful. But these are the filters that I like to use. I want to know, is their dividend growth rate increasing at least by 3% for the past 5 years? That's the dividend growth CAGR. Is their top line increasing at least by 0%, meaning it has to be positive? And their dividend yield at least 1%. And then the RSI is very speculative, but it's a technical analysis indicator that shows whether or not a company is oversold. So the theory goes like this. If it hits a 30 and below, then that means that stock has been oversold, the RSI. But if it's above 70, that means way too much money has pumped into this stock at a pace that's way too aggressive recently, meaning there's going to be a pullback. People are going to be selling for their profits, and all the various ETFs and hedge fund managers out there are going to be selling and trimming their positions so that their portfolios are a little more balanced. So realistically, most stocks usually trade between a 45 to a 65. However, if you see an RSI around 30 or a 25 or even a 20, it usually tells you that they're probably near their 1 year low and they're ready for that bounce back. Or they're going to continue falling like a person that had one too many margaritas and they're wearing high heels. They're going to be falling all the way down. So these are the various filters that I like to do to find undervalued stocks in the entire stock market. And by the way, there's a free way to do this. Let me share with you right now. So this website is called FinViz, and as you can see, it's almost the exact same thing. I don't really use this one. I just use stockanalysis.com. By the way, huge shout out to them. If you use my referral link down below in my description, it gives you 10% off whatever deal or promo they have going on. So it stacks on top of that. I prefer stock stockanalysis.com because it's a little more visually palatable and digestible. Whereas with FinViz, you gotta be really a data and numbers kind of guy to like this format instead. So having said that, if we jump on back over to stockanalysis.com, with my preferred filters, it kicks back 60 stocks that are worth investigating. The first one is gonna be the Coca-Cola Company. Past 5 years, their dividend has been growing at a rate of 4.3% year over year. It's usually a proxy for their bottom line per share's growth as well, because on paper, you can't really grow your dividend unless your earnings per share is growing in conjunction. Because think about it like this. If your earnings per share is decreasing, then how the heck are you going to be able to afford a dividend increase? It just doesn't make sense in a cash flow equation. Now, as a general rule of nipple, usually if the EPS grows at a rate of like 10% year over year, then the dividend growth rate is usually half of that or a third. So it'll be like a 5% dividend growth rate or even like a 3% dividend growth rate. So the Coca-Cola Company, their dividend is growing at a rate of 4.3%. Their revenue is growing year over year at a rate of 1.2%. That means their gross sales are increasing, and objectively this company is still growing, and their dividend yield is 3%. And their current RSI is at 34. So on paper, Coca-Cola hits all 4 of the metrics that makes me curious, that makes me want to look them up as I'm sitting and scrolling on my phone at 10 p.m. at night, and I'm like, should I buy into them or not? So Coca-Cola, worth investigating. We also have Texas Instruments. They've made this huge pivot from manufacturing calculators for algebra. Instead, now they're trying to manufacture semiconductor chips for the US, but they're also competing with Intel, TSM, and I believe Samsung. And their RSI right now is a 31. So let's see what's going on. If we click on ticker symbol TXN, take a look at their year to date. As you can see, they're just going on a sell-off. They reached a high back in July of 221. Now they're 182. I'm also going to make the assumption that back in April, when the overall stock market went on a sell-off, their RSI was probably a 20 or a 25. Because right now it's around a 30, 31. Take a look at their financials. This is very inconsistent. This is exactly what I don't want to see. However, their strategy shift occurred in the past few years. So I guess time will tell whether or not their revenue is going to be consistent and increasing year over year. However, the volatility leading up to that point, I guess it makes sense with their old school business operation, but now that they're in the manufacturing of semiconductor chips, maybe it'll be better for them. Take a look at their dividend profile, 4.6% growth rate, 21 years of dividend growth. Payout ratio is very alarmingly high at 99.4%. So this is a teaching lesson right here. Their dividends paid out per share is $5.44. If we jump on over to their financials, scroll on down and take a look at their earnings per share, it's $5.47. That means they're practically paying out every single penny of their profits per share as dividends to the shareholders. Now you tell me, it doesn't take a rocket scientist with a PhD to understand, do you think that dividend is going to be sustainable and growing in the near future? No, if the payout ratio stays at 99%. However, every 3 months, a company updates and posts their financial progress known as their earnings, and they might be able to increase their EPS, which will bring down that payout ratio. So if we scroll back up here and break it down on a quarterly basis, take a look at their earnings per share, it's doing exactly that. So quarter over quarter, year over year, it's going up by 15%. I'm going to go ahead and assume that next time they report their earnings, it's also going to go up by another 15 or 20%. And so that payout ratio is going to be slowly coming back down. So when you look at it with a closer examination, it seems like the dividend is okay. But friends and family, we're still working with a 99% dividend payout ratio. So for that alone, knowing that the health of their dividend is in jeopardy, I'm kind of backing off for now. And I say that because if we jump on over to Intel, this used to be a company that paid a dividend, but as you can see, their dividend profile says not available because in 2024, they paid out their last dividend per share to the shareholders of 12 cents. And after that, they cut it. They don't pay a dividend anymore, as you can see. They cut their dividend and then they just got rid of it altogether. So for me, seeing that happen from Intel, that's now in the semiconductor manufacturing line of business, which is what Texas Instruments is trying to do, it makes me hesitate and pause. I'm not saying that it's going to happen to Texas Instruments, but the numbers are not in their favor. So if we go on back to the overall stock market screener, we had Texas Instruments. We just took a look at them. Is there anything else that's interesting? Obviously, we can go down line item by line item. There's Union Pacific. I really like this company. I think they might be acquiring Norfolk Southern. I just sold out of Norfolk Southern. I'm not sure if that merger is going to go through or not, but we also have Honeywell, a huge competitor to 3M. They basically do the exact same thing. A huge industrial company that makes parts, supplies, and patents for all different sorts of stuff for almost every single industry and sector. We have Waste Man. Unbelievable. That is something that is interesting. So when you think about waste management, the business of throwing away trash, recycling, it's a business operation that I believe is a buy and hold forever. If you want my elaborate thoughts, then go and watch the video where I talk about the buy and hold forever stocks. Look at their dividend growth rate. Past 5 years, every year on end, 8.4% on average. Their revenue is growing by 14%. Dividend yield is 1.5%. But their RSI is a 36, which means the market right now, they're selling out of the waste management. Definitely a company that is on my radar. But in terms of execution from their leadership and management team, I personally would prefer Republic Services to that of Waste Management. No, I don't hold either one. I don't have skin in the game. I'm not being biased. But from my understanding, Republic Services, a little more well-managed than Waste Management, which is funny because their name has management in it. But out of the entire trash space, the one that I would buy is not them. I would rather buy into Waste Connections, ticker symbol WCN. I think they're better because their strategy is servicing the areas that are outside the major metropolitan and urban areas. So their business model copies Dollar General. I think of Waste Management and Republic Services, how they're fighting for all of the big contracts in big cities like Walmart versus Target or whatever, or Walmart versus Amazon. Whereas Dollar General, dude, they're servicing the rural areas, the places in the US where they don't have a Walmart nearby. And that's why I really like Waste Connections, because they have effectively a monopoly. No one else wants to compete with them. You love to see it. You also have UPS, Keurig Dr. Pepper, SBA, Texas Roadhouse. What is going on? Take a look at their dividend growth rate, please. Can we just have a moment of silence here? A 46% dividend growth rate. Are you kidding me? And their revenue is growing year over year by 14.6%. Dude, phenomenal operations. A long time ago, I think maybe 2021. No, I think it was 2020. I completely sold out of Cracker Barrel, and I decided to allocate that capital into Texas Roadhouse. Past 5 years, they've basically compounded my money invested into them. It has been such a lucky decision. And the fact that right now their RSI is a 33, I would love to investigate them further after this video, because these numbers right here screams that they're crushing their operations. If you scroll on down, I want to see if there's anything interesting as we head towards the bottom of the list. Oh, there's ABM. They're in the business of taking care of your facilities, your buildings, your office, your warehouse, and making sure that it's clean and sanitary. They have janitorial services. They also help take out your physical trash all over the bins on every single floor of the building itself. And there seems to be one more page over here. Yes, there's 10 more companies every year. I think this is a perfect opportunity to talk about a company that is not undervalued whatsoever. So the Wendy's company, they basically have the exact same business model as McDonald's. They sell hamburgers with a franchise business model. I mean, their numbers look impressive, right? On surface level. Dividend yield is almost 6%, dividend growth rate. So what's going on? Let's investigate further. So if we click on ticker symbol WEN, year to date, down by 40.7%. And that's why their RSI is around 30, because they're going on a sell-off almost every single week without fail. We zoom back 1 year, it's just on a downward trend. If you take a look at their financials, their revenue, rock solid, I think, looks pretty impressive ever since 2017. Earnings per share seems to be stabilized. That's okay for a mature, established company. Obviously, the best outcome is you want to see it be growing consistently. But for a mature and established company, sometimes stability, you got to take it. And if we take a look at their free cash flow situation, the cash that's generated from their operations, $256 million. Things don't look too bad so far, but this is where it might get a little ugly. If you take a look at their cash and cash equivalent situation, absolutely volatile. Sometimes it's up, sometimes it's down. It's not consistent, nor is it stabilized. Well, I guess it's consistent in that it's just all over the place. And the amount of loans on their books, $4.1 billion. So if you use all of your cash on your books to pay off your loans, you still have $3.8 billion of loans. They're highly leveraged, friends and family. Jump on over to their dividend profile, 6% dividend yield, payout ratio is 81%. But what I want to show you is if we take a look at their dividends visually depicted, they cut their dividend during the pandemic in 2020, but they also cut their dividend in 2025. Because I always say on this channel, once you cut that dividend, the moment they experience a hardship or an obstacle in the next 3, 5, or 10 years, they're going to cut the dividend again. So for me, this company I would avoid. Even though their financials look okay, the reason why the market is selling out of them is because it's not that they're undervalued, but it's because this company's future looks pretty rough. I would argue the much better alternative is the best in class, which is McDonald's. And I say that objectively. They are just at the top of the game when it comes to the hamburger stocks. I mean, max 86,000% from their share price total return. So that's using the stock screener to take a look at the overall market. And now I'm going to show you how to use the stock screener to screen and look for potential 10 baggers. So if we jump on over to the stock screener page, I already pre-saved it. It's titled multi-bagger. These are the indicators and filters that I like to apply. I like to look at their revenue growth for the past 3 years, and I want to make sure that they're not a giant company. Because for a company that has a valuation of like, I don't know, $500 billion, for them to get to $1.5 trillion, that's going to be so much more difficult than a company that trades for about $300 million for their market capitalization, and then to turn that into like $6 billion. Does that make sense? And then, of course, I want to know that they're generating cash from their operations, which is why I have the free cash flow indicator also there. But there is also one more that I want to add, and that's going to be in the category of their earnings per share, because I want to know that their profits per share is growing in the right direction. And if we go right there, so revenue growth in the past 3 years, at least 10% year over year, market cap under $3 billion, free cash flow to be positive, and then for their earnings per share growth, let's see, at least over 5%. No, that's too modest and conservative. What if we say something like 10%? It has to be at least 10% of their profits are increasing year over year. And then if we take a look at what's represented on the screen, then we have a compilation of stocks where, to be quite transparent with you, I've never heard of any of the top 10. I don't know Fortuna Mining Corporation, Euroseas, but on surface level, their numbers look pretty crazy and wild. I mean, their earnings per share growth is freaking 118% year over year. Take a look at this. Jump on over to their earnings per share. Do you see what's happening? This is funny money. So their average is ridiculously high because of 2020 to 2021. But since then, it's just been kind of rocky. But I would argue it's not bad. But that average has definitely been diluted by that one spectacular year. So instead of filtering them by their EPS, why don't we do by their market cap? Okay, so we have Buford, AAR, anything that I would recognize. I mean, some of these are ridiculous, like Trupanion. Take a look at this. Free cash flow, $61 million. Earnings per share growth is 40% year over year for the past 5 years. Revenue growth, 19.2%. Okay, so let's take a look at Trupanion. And what is this company? They provide medical insurance for cats and dogs. So it's an insurance business for our furry friends. They were founded in the year 2000 and it's headquartered in Seattle. All right, so let's take a look at their financials at a closer level. Oh my goodness gracious. Their total revenue situation is just absolutely bananas. phenomenal. Take a look at their earnings per share. Okay, so they were unprofitable up until now. So this is a company that is finally in the green. So that's another check in the box. 2 for 2 is good. What about their balance sheet? Are they cash heavy? And because this is an insurance company, I take a look at their float, which is represented by the total investment. Looks pretty good, 197 million. And their total debt is 114 million. So after accounting for all of the debt that's on the books, they have $8 million of cash left over. So it's a cash heavy company. I would argue their balance sheet looks pretty good. What about the free cash flow? They're probably positive, right? Free cash flow per share is $1.43. They've actually been positive since 2024. Okay, so far, oh my gosh, I think I might have found a pretty good company here. Do they pay a dividend? No dividend, because they've only been around for a little bit, right? They've been around for a while, since 2014, but year to date, dude, this company's getting hammered. Oh, wow. They're trading multiples of 172. So I would argue they're trading for a very, very expensive premium. So it looks like the market knows about them. They're not undervalued by any means. Could they be a 10-bagger? I think so. I mean, their market cap is only 1.8 billion, but for me, I feel really uncomfortable going near any company that has a trading multiple above 100. If it's in triple digits, I'm kind of like, ooh, man, that's a little expensive. Which means we could probably add one more indicator so that we can account for that. So their forward trading PE, how about it has to be at least how about we do under 25? And now that spits out 69 stocks, and they're in alphabetical order by their market capitalization. Let's see if we can find, because I want to find another one that was just like Trupanion, where their PE is still low. Because then you're buying into them when they're still under the radar, while the markets are kind of like, they don't know who they are yet. DXP. 31% EPS growth, forward trading multiple is a 20. Their business model. Together with its subsidiaries, they engage in distributing maintenance, repair, and operating MRO products. Have no idea what that is. It operates in 3 business segments: service center, supply chain. Oh, I know this company. They're in the business of doing the gas stations and the infrastructure to run said gas station. So I think they're a parallel play to the oil and gas field, which is probably why their trading multiple is so low. Take a look at their performance. Yeah, I mean, they're at an all-time high. I think the cat's out of the bag with this one. They're pretty much the exact same price, 118 as they were back in 2012 or 2013. If you bought into them for $110 back in December of 2013, you're probably not a happy camper, and you're probably thinking that DXP is a piece of crap. But if you did, in fact, buy into them during the, I don't know, I guess November of 2023 at $32 a share, you practically 3 or 4x'd your money. So it depends on when you bought into them, but I think anything in the oil and gas field, I kind of pause and I hesitate because it tends to be cyclical. They have their highs and their lows. They're not slowly and steady growing. Does that make sense? And that's why I personally stay away from the commodities, but I think it also makes sense if you buy into them when they're on the low end of their market cycle. And if you just hold on, I guess that's a good yield on cost, especially if they pay a dividend. But just knowing that in the future that it's going to tank and go into the red depending on their market cycle, it's not for me. I know my risk tolerance, and that's just not my cup of tea. I mean, to be quite frank with you, there's a lot of companies, but there's nothing that really jumps off the screen for me. I mean, obviously the pharmaceutical ones, I don't even bother looking at. It's just a sector that I do not invest into. Let's go to the next page and see if there's anything crazy or interesting. But I guess that makes sense. I don't recognize these companies because they're probably under the radar. Like, they're not on the map yet of most investors. Anyways, I hope you enjoyed this video. I know it's different from my usual content, but genuinely deep down, I love teaching people and sharing information that kind of works with me. So to make this tutorial, if it resonated with you, let me know, because I can make this style of content for almost anything related to the stock market. And with that said, I love you guys. Stay safe. Good luck in the stock markets. And when I say I love you guys, I mean it. Because by you watching this video, engaging with the content by clicking like or leaving a comment, you literally are allowing me to do what I love to do, which is to make YouTube videos and to share my passion of the stock market with everybody else out here. Now, if you want to support the channel, I do have a Patreon, but do not feel any pressure to join it. And I don't know if I ever mentioned it, but my wife and I were expecting our first baby in the next like 5 weeks or so, and we do have a baby registry list. I'll have it in the pinned comment. I don't know if guys do this kind of thing, but if you have a moment, please check it out. Anyways, I'll talk to you guys next time. Peace.